Your core banking migration just cost you $12 million this quarter. Still delaying that decision? By the end of this, you'll know the exact bottleneck turning modernization into quarterly hemorrhaging, and the single conversation that stops it. Here's what nobody tells you about core banking modernization. The real cost isn't the platform license or the implementation team. It's the compounding loss happening while you're stuck in analysis paralysis. Every quarter you delay migrating off that legacy system, you're bleeding opportunities your competitors are capturing in real time. We're talking about customer acquisition costs that double because your digital account opening takes 48 hours instead of 4 minutes. We're talking about commercial clients who choose another bank because your loan decisioning can't keep pace with their growth timeline. We're talking about operational expenses that climb 15% year over year because you're running parallel systems that were never designed to talk to each other. The big three, Fiserv, Jack Henry, and FIS, serve roughly 70% of U.S. banks. They've all released modern core platforms. But here's the gap. Most institutions treat the migration like an IT project, when it's actually a complete business model shift. Your executive team approves the budget, your IT department creates a 3-year roadmap, and then something happens. The timeline stretches. Scope creep sets in. Internal stakeholders start pushing back because they're worried about disruption during the transition, and while all of that's happening, your cost structure is getting worse. Not staying the same. Worse. Because you're now paying for the new platform license while still running the old infrastructure. You're staffing 2 teams. You're maintaining integrations that serve a shrinking portion of your business. And most painful, you're watching digital native competitors onboard the customers you should be winning. The institutions we work with describe this phase the same way. It feels like running a marathon while carrying someone else's backpack. You committed to the transformation, but you're not experiencing any of the benefits yet. Just the accumulated weight of operating in 2 worlds simultaneously. This brings us to Robert Sullivan, regional bank, mid-tier institution, about $4 billion in assets. He'd been wearing those silver-rimmed reading glasses for 20 years. And he had a tell. Whenever he was working through a decision that kept him up at night, he'd adjust them. Slow, deliberate, buying himself a few seconds to think. When we first sat down with Robert, he was 8 months into a Fiserv migration. The board had approved it 18 months prior. The original timeline projected go live in 12 months. But 8 months in, they were only 30% through data migration, and the internal pushback was intensifying. Branch managers were worried about training timelines. The lending team was concerned about disruptions to their pipeline. Compliance was flagging potential gaps in reporting during the transition. Every department had a reason to slow down. Marcus Chen pulled up his tablet, the carbon fiber one he carries everywhere, always loaded with real-time dashboards. He asked Robert one question. What's the actual cost of waiting another 6 months? Not the emotional cost. Not the strategic disadvantage. The actual dollars. Robert didn't have an answer. That's when Marcus walked him through the math. The quarterly bleed wasn't theoretical. Customer acquisition costs had increased by 22% because their digital onboarding experience couldn't compete with what prospects were seeing at challenger banks. They'd lost 3 mid-market commercial clients in the past 5 months, not because of rates or relationship issues, but because those businesses needed faster loan decisioning and real-time treasury management. Their legacy core couldn't support it. They were running dual licensing costs for the old and new platforms. They were paying external consultants to manage integrations that wouldn't exist once the migration completed. And their internal IT team was split between maintaining the old system and building the new one, which meant neither was getting full attention. When Marcus added it up, the delay was costing them just under $12 million per quarter. Robert adjusted his glasses 3 times during that conversation. The turning point came when they reframed the entire initiative. This wasn't an IT migration. It was a revenue protection strategy with a hard deadline. Robert pulled together a task force. Not another steering committee, but a dedicated team with one mandate: go live in 90 days. They stripped out every non-essential customization. They accepted that some workflows would feel different and planned change management around, rather than trying to recreate the old experience on new rails. They prioritized data migration for active customers and current products, then scheduled legacy data conversion for post-launch. They brought in specialists who'd done this exact migration at other institutions, people who knew where the hidden bottlenecks lived. And here's the part that changed everything. They integrated their loan origination system, Abrigo, early in the process, instead of treating it as a post-launch task. That decision alone shaved 6 weeks off the timeline, because they weren't trying to jury-rig workflows between systems that weren't designed to sync. Abrigo accelerated their commercial lending pipeline, and having it fully operational on day one meant their relationship managers could actually serve clients better immediately after go-live, instead of asking them to wait through a transition period. The integration meant loan data flowed seamlessly without manual handoffs or duplicate entry points that had previously created errors. Stay with this number for a second. It's bigger than it looks. Within 45 days of going live on the modern Fiserv platform, their digital account opening dropped from 48 hours to 11 minutes. Their commercial loan decisioning, the thing that cost them those 3 mid-market clients, went from 9 days to 36 hours. And because they weren't running dual systems anymore, their operational overhead dropped by 18%. But the real shift was psychological. Robert's team stopped defending their limitations and started leading with capabilities. They weren't apologizing for slow processes anymore. They were competing on speed. 6 months post-migration, they'd recaptured the cost of the entire transformation through saved operational expenses and recovered customer acquisition momentum. The $12 million per quarter bleed stopped. Not slowed down, stopped. So here's your one move. This week, pull your CFO and your head of IT into one room. Ask them to calculate your actual quarterly cost of delay. Not the project cost. The opportunity cost. What are you losing right now by operating on infrastructure that can't support the customer experience your market expects? Get that number on paper, because once you see it clearly, every internal objection about timing and risk gets reframed. You're not deciding whether to modernize. You're deciding whether you can afford to keep bleeding. If this changed how you're thinking about your next system decision, subscribe. Next time we break down another blind spot banks are missing. Knowing isn't enough. The next step is where most businesses fail.